Okay, so this is mainly going to be for people who were unable to come to class today, but this is what we went over in class for those of you that are either reviewing it again or were unable to make it today. Basically, the format of the exam that we're going to have on Thursday is going to be 20 multiple choice questions, and basically the review here covers all of the question types. Obviously, numbers and such will be changed, so it won't be the exact same questions, but very similar question types to this for all. There's 14 questions on this review, and this will cover basically all of the concepts you'll need to know that deal with journal entries or calculations on the exam. So the only other material on the exam that you'll need to know that's not covered in this review will be items from the slides and or chapters that deal with definitions and concepts, but there will be no other questions other than these types of questions that deal with calculations and or journal entries. So starting with question 1, we have partnership forming. There's 3 partners, and we're asked to show the journal entry here for the contribution made by partner A. So that would be a debit, and remember this is in the perspective from the partnership, so it'll be a debit of $25,000 for the cash contributed, a debit for the equipment that's contributed, and remember we're looking for fair market value here because that's what it's worth to the partnership. So we don't worry about the book value or the depreciation, we just worry about the fair market value. And then we will have partner A capital. Will just be the total of these 2 debits, and that will be the amount that's going in the partner A's capital account. So that will be $44,000, and there you go. I'll put in bold all of the final answers for each of these questions. Okay, so there's question 1. For that one, though, remember that we were just asked to show the contribution for partner A, and remember that sometimes there'll be other numbers in here that are not relevant to the question. Like in this case, all you needed to know is the fair market value of the non-cash asset and then the cash amount. Whoops. Okay, question 2. We're assuming that each of these 4 partners shares equally in the net income or net loss, and this is basically closing out the end of a period. Well, to close it out, there's several steps, and like the question here states, that the answer that we're looking for is actually step 3 in this process. But I'm going to go through step 1, step 2, and step 3. So step 1 is going to be closing out the revenue accounts. Since you see over here that these revenue accounts are credit balanced accounts, to close them out, we need to have a debit to those accounts. Okay, and then the credit is going to be to income summary. Okay, so that's step 1. Step 2 is the same process, but we're doing the expense accounts this time. So our debit is going to be to income summary for the total of the expense accounts, and then we'll have a credit for each of the expense accounts to close them out. Oops. Okay, so step 1, close out the revenue accounts. Step 2, close out the expense accounts. If you were making a T-chart that showed you had debits over here, credits over here, you would take the credits from the income summary, put that there. You would take the debits from the income summary, and if you total these up, that's 171. Okay, so you just take the debit entry from over here, it's 171, and then to figure out what the final net income is for this company, we just need to net these two together, and since the credit side is the bigger side, that's the side that's going to have a balance when you net those two together. So if you just do 440,000 minus 171,000, and your net income is going to be 269,000, and that's a credit. Okay, so this was just step 1 and 2, but that gives us the information that we need to do step 3. And step 3 is just distributing out this net income between the different partners. Okay, since this is a 4-way partnership where each one splits it equally, you're going to take the net income, 269, and divide it by 4. And so this number here is to each partner, okay, because that's their share of the net income. So our journal entry will look like this. Since our income summary account has a credit balance of 269, we are going to want to close out that income summary account with a credit. I'm sorry, that should be a debit there. Brain's not working so well. Okay, so we're going to close out the credit balance with a debit here, and then we're going to make credit entries for this amount to each of the 4 partners' capital accounts. So we have X, let's see, we start with W. W capital, oops, there we go. Credit to X capital, credit to Y capital, credit to Z capital. So that right there is our answer for this question. But you see I had to do step 1 and step 2 to be able to come up with what the income summary was and what the net income was. Then I had to split that between the partners. And since it's divided equally, I just divided this into 4 pieces. But remember, this could also be divided where one partner gets 50%, another gets 20, another gets 20, another gets 10. So in the question, whatever percentage the partners get, that's the amount you're going to have to divide this number by. So it's not always going to be an equal amount to each partner, but you just need to get to this number and then divide it equally and put the correct amount in each partner's capital account. Okay, question 3. Whoops. We are liquidating a partnership here. And you see that the income ratio is 60% to partner Johnson, 40% to partner Smith. And what we're looking at is the buildings account here. Remember, the first step here is we have to turn all non-cash assets into cash. So we have three types of non-cash assets. We have a book value for each of those, and then we have the amount that they sold for. And what we're doing for this question is we need to allocate the gain or the loss from this sale to the partnership. Okay, so you can see here the value is $100,000, $30,000 is what it sold for. So this is basically a $70,000 loss that we're taking on this. Okay, but the way that we do this journal entry, first thing we do is show the amount of cash that we got. Okay, so we got $30,000 in cash. we also got rid of an asset. So the buildings account went down by $100,000 because that was the book value of the asset. And you see the debits and credits don't balance here. So what we're missing here is $70,000 worth of debits, and that's where the loss is going to show up. So we just have to divide that with 60% of that $70,000 going to Johnson, 40% going to Smith. So I'll have Johnson capital, Smith capital. And so in these cells over here, I'm just going to have the calculation done. So 0.6 times 70,000 and 0.4, whoops, equals 0.4 times 70,000. And that gives me my amounts. The 70,000 is divided according to the income ratio for these two partners. The equation balances, or the entry balances. So that's my final answer there. Question 4. Corporations declaring a stock dividend. 2 million shares available, and the dividend is 30%. So what that tells me is of these 2 million shares, I'm going to distribute 30% of those. So the first thing, whenever you see a stock dividend question like this, the first thing to do is to convert available shares in percentage to an actual number of shares that we're going to distribute. So I'll take 2 million and I'll multiply that times 30%, and I get 600,000. Oops. Okay, so I have 600,000 shares that I'm distributing here. So the way the journal entry looks, I have a debit to stock dividends, and that's going to be the number of shares times the fair market value of those shares. So I have 600,000 times $60 per share, and that gives me $36 million if I'm looking at the numbers right there. Okay, and then I have a credit to common stock dividends distributable, and that's just going to be for 600,000 times whatever the par value is, in this case $30, so half of that amount. So this is actually going to be 18 million. And then the difference between those two is paid in capital in excess of par. Okay. And there's my answer. Question 5, B Corp has already declared a 15% stock dividend. Now, and this journal entry up here was as of the declaration date. And this next question is asking me, what do you do as of the payment date? So we're going to assume we already did a journal entry that looks similar to this, but with these numbers in it for the declaration date. And now when I'm looking at what happens as of the payment date, really this middle part of the journal entry done on the declaration date is the only part that I'm worried about as of the payment date. So in this case down here, I think it helps. So I'll real quickly do the journal entry that I would have done on the declaration date. So on the declaration date, I would have said, okay, 15% times 100,000, that's 15,000 shares. So I'm going to have stock dividends of, 15,000 times the fair market value, $20. So I have 300,000 there. Credit common stock dividends distributable. And that's just going to be the 15,000 shares. Whoops. Times the par value, which is right there. So that's 180,000. And the difference between those two, 120,000. Okay, so like I said, the only thing that I'm worried about as far as of the payment date is how much is in this common stock dividends distributable. And this is basically functions like a liability account because that's telling me how much stock I'm going to have to distribute as of the payment date. So I will just cancel that debit entry out by doing, or cancel this credit entry out here by doing the opposite debit entry here. And that just goes into the common stock account. So the answer is this journal entry here, but you may, if you encounter a question like this, you may have to go ahead, do the first step, which is the entry as of the declaration date. Pick out this middle number here, common stock dividends distributable. Cancel that entry out with a debit here, and then credit that amount to common stock. Okay, this is an easy one. Corporation declares cash dividends. Well, all we have to do for cash dividends is put it in the right format. Debit to cash dividends for whatever the amount is. Credit to, dividends payable. And there you go. As of the declaration date, that is your entry. Okay, Corporation DT sells 650,000 shares of common stock, par value of $2 per share for $8 a share. Okay, so first of all, since we're selling this stock, this is going to be cash to us. So it will be 650,000 shares times $8 a share. And that works out to 5.2 million. Then we'll have a credit to common stock for 650,000 shares times $2 per share. And that gives us 1.3 million. And so the difference between those two just goes in paid in capital and excess of, excess of par. And that's just 5.2 million minus 1.3 million, 3.9 million. Okay? So there's your answer. I just put I put these cells in this format here with the dollar signs, even though journal entries don't usually have dollar signs, just so you can see where all the commas are, so you can see what the number is. It's just hard to read if you just have a bunch of numbers next to each other. So you don't have to put the dollar signs in there, and technically that would be incorrect to put those in there. But just don't worry about that part. Okay, number 8. If 25,000 shares of common stock with a par value of $69 per share are sold for $29 per share, and there's an $800,000 credit balance and paid-in capital in excess of par before the stock sale, what's the entry to record the sale? So in this example, we sold stock for greater than par value. In this question, we're selling it for less than par value. Okay, so first step again, figure out how much cash we're getting. So you just multiply number of shares, 25,000, times what we're selling them for. We're getting $725,000 in cash. Then, for common stock, again, we're just, let's put that down here. For common stock, we're just, again, multiplying number of shares times par value. And that's, again, I'll change that to dollars so you can see where the commas are supposed to be. So we're basically losing $1 million here. Okay. Oops. You add one more line here and give us enough space. Okay. So it's unbalanced, this entry. We need another $1 million of debits. So the question is, where do those come from? Well, we see there's an $800,000 balance in paid-in capital in excess of par. So we will use up all of that amount. Remember, you can't take that account lower than 0. So we'll use up all of the credit that we had in there, $800,000. We still have $200,000 that we have to put in here, so that will come out of retained earnings. So remember, if you're making up a deficit here where you sold the stock for less than par value, if there's a balance in paid-in capital, you take the money out of there first. If there's no balance in there, it would have all come out of retained earnings. Okay, so first step, use any paid-in capital that you have available to you. And then anything that's left over after that, retained earnings. Okay, so there's the answer to that one. Okay, Zenith Corp issues 500,000 10-year 3% bonds. At full maturity, what is the correct journal entry upon retirement? Well, we're basically saying, so issuing bonds is like borrowing money. If you issue $500,000 worth of bonds, at the end of the 10 years, you've already paid interest year by year. At the end of the 10 years, when you're paying back the money that you borrowed, what you pay back is the face value, which is this number right here. So that's really the only number that we're concerned with here. It doesn't matter the 104 rate that was paid for it, doesn't matter. The interest rate doesn't matter. We're just concerned with this number right here. Because when we issued these bonds, we recorded a liability to bonds payable for $500,000. That was a credit, and right here this debit cancels that out, and we have a credit to cash, and that is all we do for the entry at maturity. Okay, so question 10 here is asking about interest. Okay, so again, we're talking from the perspective of the company issuing the bond. So we're paying this interest. And to figure interest, we just look at the interest rate. That's a yearly rate. We multiply that times the face value. So 10% times 800,000 gives us $80,000 in interest per year. This question says interest is paid semi-annually. So we'll take that 80,000, divide it by 2 for each semi-annual payment. And so each payment will be $40,000. Okay? After we know what the payment is, we just put it into the correct format, which is like this. And that is what it looks like. Okay, so that's from the perspective of the company selling the bonds, who's paying the interest. This next question, very similar. We're again wanting to know what the initial interest payment is. Again, it's a semi-annual interest payment. So again, we'll look at the face value. We'll multiply it times the percentage rate. So we'll have 350,000 times 8% gives us 28,000 annual interest. We'll divide that by 2 because it's semi-annually paid. So the interest payment is going to be 14,000. But in this question, we are the ones who purchased the bonds, so we're actually getting this interest. So I have a debit to cash of 14,000 and a credit to interest revenue 14,000. Okay, so make sure you pay attention to which perspective you're looking at it from. Okay, question 12. Stock A costs $21,000 to purchase. It's now worth $20,000. It is a trading security. What is the correct journal entry to show the adjusting entry we need to make for the financials? Okay, the fact that it's a trading security is important here because that will determine what the journal entry looks like. Okay, so we're going to debit the amount of the unrealized loss on the income statement there because it's a trading security. So the account is unrealized loss income, and then credit market adjustment trading, and that's what the entry looks like. You have some slides that go over the differences between available for sale and trading securities that you can look at, but for the purposes of the final, just make sure that you know this format. Okay, question 13. You're given some abbreviated portion of a balance sheet here, and you're asked for the current ratio. Well, the current ratio is just current assets divided by current liabilities. So in this case, we have current assets, $2 million, divided by current liabilities, $750,000. This is my current ratio. If I was going to round it to 2 decimal places, 2.67. Okay. Finally, if you have estimated annual overhead costs of $2,500,000, estimated direct labor of $5 million, estimated direct materials of $6 million, and expected annual operating activity of 5,500 hours, what is the predetermined overhead rate? Well, to calculate predetermined overhead rate, the only numbers that we care about is estimated overhead and estimated operating activity, and we're just going to take estimated overhead, divide it by estimated operating activity. So we have 2.5 million divided by 5,500 hours, and this gives us a dollar amount, and that's going to be per hour. Okay, so we had dollars over hours, and that gives us dollars per hour. Okay, so these other costs, the direct labor and direct materials, are just thrown in to throw you off the scent here, but all you're really concerned with when calculating predetermined overhead rate is annual overhead costs and operating activity. And that's it. So any other questions that you see on the exam will just be definition/concept questions. So if you don't know the answer right offhand, you'll just have to look those up. But this is it as far as the journal entries/calculations. So don't spend too much time looking at any slides or anything else that covers journal entry calculation concepts that are not covered in this review, at least for the purposes of the final.